Thanks, Jen. And welcome, everybody. Great to have you all in our discussion. I'm joined by my partner. I'm John Lutkowski with Goodwin Procter. I'm joined by my partners, Jeff Klein and Ali Ramadan. We practice in the tech and life sciences area and do a lot of work with prop tech companies at all stages of development. And we thought we would share today for some of the earlier stage entrepreneurs the best practices and what we call the 8 great actions every tech entrepreneur should take when starting a business. So without further ado, we'll jump into these. And if you have questions, please type them in as we go, and we'll do our best to address them. And apologies, the slides are a little small, as Jen mentioned. If you'd like copies of them, we can send them along. So the first, and we'll spend a little time reading, unfortunately, just so that you know what we're talking about. The first great action is paying attention to corporate formalities. I don't want to spend a lot of time on this, but it is critical at the beginning stages of forming a business that you actually form the business. You take the time to incorporate in whatever jurisdiction you're going to incorporate in, or you form your LLC, and we'll talk a little bit about those in a minute. But getting that document on file as early as possible and issuing equity to the founders with whatever restrictions you think you want to put on those shares is critical. And let me spend just a minute talking about the equity issuance. As you look around the table with your founders at other sides of it, you're going to want to think about how much equity, how much of this company should we each own? And probably as importantly, should we own that out of the gate, or should that equity vest over some period of time? And when we work with most founders, they do want equity to vest over time because they want somebody tied to the business. If somebody were to leave in 1 year and the business is only a quarter of the way through its development, having that person keep 100% of their equity is typically not a fair approach for most founders. So thinking about how founder equity is going to vest is a critical piece of forming the entity. We say in one of these final bullets, give corporate and legal matters the same respect as your source code, lab notebooks, engineering documents. And it really is that simple. You know, the formation process is relatively straightforward. It is relatively cheap. Goodwin has a free resource that we open sourced out to the community for people to form the company, form an enterprise wherever they want to form it, and take advantage of those free resources and get it done early so that you don't run into trouble later on as you're beginning to finance the company. So let's turn to the second 8 great actions, and that is simplify the formation process. So this is the flip side of the coin we were just talking about. In getting your corporation up and running as quickly as possible, don't complicate it. There is no reason to make a certificate of incorporation a treatise on economic distributions. This is a very straightforward process. Treat it that way. It's fair to have questions about whether you want to be a corporate entity, so a corporation, or an LLC. Those are fair questions. My general advice to companies is just form a corporation in Delaware where 90% of every other corporation is formed, and don't complicate things by forming an LLC, which has some tax benefits, but at the end of the day, everything you do with an LLC will cost you more because LLCs are tax-driven instruments, and they're tax-driven entities, and everything you do, including incentivizing employees in the future, raising capital, complicates matters with an LLC. It has benefits from a tax standpoint, but you can get 90% of those same benefits from an S corporation. So my recommendation is keep it simple, file a corporation in Delaware, make an S election so that you have a pass-through entity and you're not taxed at the corporate level and the individual level, and you will be in good stead. So I will stop there and turn it over to my partner, Jeff Klein, I think next.
Hey, everybody. Thanks, John. I want to address founder equity and drill down a little bit more on what John just mentioned. This is truly a critical decision when starting up a business. There's really not a lot of science here, but I find it really works best when founders are transparent and take on the conversation to really think in a deep way about kind of the past, the present, and future value contributions of each of the founders. Such that, a lot of times people will kind of split it 50-50 if there's two founders, or 33 across the board if there's three. But often, while that's a blunt instrument, I also think that people who do it right also pause and think about, what is going to be the kind of the journey and the trajectory and the value contributions. I think where it doesn't work very well is when folks just kind of avoid it, even though it's the big elephant in the room. And that often creates problems, as well as a dysfunctional kind of relationship with founders, because what goes unsaid often is in people's thoughts and in their hearts, and there's sometimes some resentment. So this is truly, like anything, a working group and a collaborative exercise. And I think having a good Sherpa in the form of an experienced law firm who can help moderate that conversation and kind of point it in the right direction will serve you well. If there's more than one founder, you need to earn your equity, and that's called vesting. So typically, whatever percentages or amounts of shares you land on, you want to then make sure that 100% of it is invested on day one, so that on day 5, whoever got it can go on a walkabout or spend their time on the beach, riding on the backs of labor of others. So the vesting concept is tried and true for companies with multiple founders, and typically what we'll see is that'll vest over a 4-year period, or time-based vesting. And so what happens here is, if somebody leaves before the vesting period is over, then your documents, when well drafted, will have provisions in them to make sure that the unvested shares will go back into the company. And that avoids what we'll call dead equity on the cap table, which nobody likes to see, because again, then the value contributions haven't been properly accounted for, and there are again some bad feelings and some cleanup that folks are for. So the other thing, there are some nuances to vesting that I don't think we have a ton of time to get into, but you probably hear some things of acceleration of vesting. So these are events where some vesting could accelerate, for lack of a better word, and those events are usually far and few between and should be thought through and kind of in line with market. 83B is a phrase that you should know well, and have kind of at your party chat, catalog, and really because it goes hand in glove with the vesting concept. So since the vesting happens over a period of time, the IRS, so we're talking about U.S. taxpayers here, treats that stock as not being owned until it is actually the vesting milestone occurs. So if we don't file an 83B, then what will happen is, at every vesting point, there'll be an assessment of value, and therefore a taxable event upon each vesting date. And so if your company is going up and to the right, like most of the ones that we work with, then you will have to pay a pretty hefty tax bill, and we want to avoid that. And the IRS understands that and is sensitive and supportive of small businesses. So you can file an 83B election to essentially accelerate all of the tax that would be due upon grant. And so therefore you're paying very low taxes, because the company at formation is worth very little. And that has to be filed within 30 days of actually receiving the equity, or that's a problem that you don't want to have. Finally, we also want to make sure that you have appropriate transfer restrictions on the stock, so that folks cannot just sell their stock to somebody who's not within the closed community of the company. And so we will often put a right of first refusal on those shares, which doesn't restrict them from transfer, but it does pause the transfer process and give the company and the other founders the opportunity. And so that is a great move that all folks should make, so that your shares of stock don't fall into the wrong hands, so to speak. Moving on to intellectual property on the next slide. Obviously, when we think about technology companies and the value which is created in them, a lot of it is people and a lot of it is technology. And so we also see and advise and support our companies in making great decisions in terms of protecting the intellectual property at all stages of the journey. So those IP assets, just to level set, are things like software and patents and trademarks and know-how and trade secrets. And we don't have enough time to get into all of that. That could be its own track. But the main point and the takeaway here is that getting the existing intellectual property that has been created prior to the formation of the company needs to properly go into the company upon formation. And so that is typically an interesting exercise, because a lot of our talented founders will create things before they form the company. And so what should happen, and the great move that the takeaway here is that entrepreneurs will have good dialogue and conversations with their lawyers to give them the understanding of how those pre-existing IP assets were created, so that the lawyer can help you understand whether there may be an issue there. If you've been doing like a lot of entrepreneurs do, which is moonlighting at your current job, where you may have created some existing intellectual property, which may be governed by a very company favorable form. So taking a look at how the intellectual property was created, understanding if there's any restrictions in them, and then properly transferring them into the company is a great move to make. Similarly, as you create intellectual property when the company is formed through the efforts of employees or independent consultants, it's very important to make sure that you have good hygiene and protocol, and to make sure that those assets are being assigned into the company through good use of agreements with those employees and consultants. Now, the final thing I'll mention is the NDA. A lot of people, everyone knows what an NDA is. Most people take it out and get it signed up before they have an interesting conversation about their trade secrets or intellectual property or whatnot. But one thing I want to point out is that as a startup, as an early stage company, just relying on an NDA is often not the great move. The great move is to make sure that you are gauging the level of disclosure, because once the toothpaste is out of the tube, it's very hard to put it back in. So make sure that you're staging disclosure in a way that is helpful to you and is supportive of the conversation, so that you don't show your family jewels at the first conversation with a strategic partner. And now I'll turn it over to Ali.
Thanks, Jeff. So number 5 in our actions for successful entrepreneurs is to raise enough money and not focus too much on dilution. So this is really about thinking about what you're going to need between now and your next raise. So that's probably a period of sort of 18 to 24 months, thinking about what you want to achieve by the time you get to your next round, mapping out your goals, objectives, and then thinking about what you need to do to get there, and then costing it out, and then raising the right amount of money you need now. And as the slide says, everything costs twice as much. It will take twice as long as you think it will, and unexpected things will come up. So give yourself a little bit of a buffer, and just really think about sort of raising the right amount. Don't get too focused on dilution, because it's better to raise a bit more now, take the dilution, and have enough to get you to your next round, where you can sort of have a good round, you achieve your objectives, and therefore you get a higher valuation, than actually finding you don't raise enough, and then you have to go out to market again on less favourable terms to raise more money. So it's better to sort of make sure you plan out, raise enough money at this stage to get you to where you need to be. So that's sort of an important point there. Then to move on to the next slide, and the next comment around sort of preparing a thoughtful budget sort of sit hand in hand with that. So it's really, again, thinking about, doing your sort of plan of where you want to end up by the time you're next round, what you'd like to achieve, and then costing that, working out how much that's going to cost you, what's going to be, know your monthly burn, know your cash out date. And from there, you've got sort of your roadmap to your next round, and then think about cash as you try and preserve your cash as much as you can. So hire conservatively. So, for example, and pragmatically. So, think about when you're hiring, what do you actually need to sort of get you to. Most early stage company starters don't need a full-time CFO. Maybe they can sort of outsource that function to the extent they need. What's going to add more value to your business? Is that getting in another developer? Is that getting a salesperson to drive revenue for the business? So really think about what you're doing in terms of what is going to add value to get you to the next stage. What do you need to do now? And then also in terms of trying to preserve cash, think about other options when hiring. For example, you can also utilize salaries, one element, but you've also got the tool of using equity to compensate people. So you can offer options or stock instead of a salary, or in lieu of a salary, or in addition to. And then again, just to pick up the previous points, make sure you add vesting around that to make sure that people do their job and then they sort of earn their stock. And then also think about sort of advisors. Well, there's a lot of advisors out there where you can agree fee deferrals, you can agree fixed fees. So again, think about sort of how you can try and preserve your cash and really make it work for your business, get you to the point where you can get to the next stage of financing, being as efficient as you can with your cash. The next one is crucially important as well, is pick advisors that add value to your business, and that's across the board. So that's your investor side. Think about your investors carefully, take your time, think about investors going to really add value to your business. So be that investors who've got experience of sort of traction with companies, and experiences to work in companies to grow them. Can they follow their money perhaps in future rounds? What can they bring to the table? Can they open doors for you commercially? Do they have contacts? Are they in your industry? This sort of smart versus dumb money conversation. Smart money sort of gets you to scale your business. So think about that very importantly. Take time, get to know your investors, have a cup of coffee with them. These people you're going to be working with, so are they people you see that you can work with on a long-term basis? Talk to other portfolio companies that invest in, find out what their experience is with them and work with them, and really take your time to get to know and make sure it's the right investor, because you're with them for the entire journey. So it's a really important point. And the same with your directors. You want directors who are going to add value to your board and add value to your business, not necessarily people who are just going to agree with you. You want people who are going to challenge you, who are going to guide you. Your board directors, sometimes your mentors. So try and bring, for example, other founders who've sort of scaled other companies, or non-execs who've been on other boards and they can really add value, again, open doors, perhaps introduce you to investors, and really have that benefit of, giving you the diversity you need, the mentorship, so it can guide you on, is your strategy working? Do you need to rethink stuff? They can really add value to your business for you. So it's key to have the sort of right team around you advising you. And the people who are not sort of emotionally involved with the business founders, they're sort of baby, they want to bring that business through, but actually the people who can sort of take a stand back and give you the objective advice and really help you and guide you is crucial. And then of course, lawyers, professional advisors, get a great team behind you. That's I think one of the most important things. A good lawyer, a good advisor can really help you in terms of shaping your roundup. It can help you in terms of connections. It can help you in terms of guiding you, sort of the practical advice that we're giving you today. And don't go by cost. That's one of the things I will say. There's actually very little cost in it most time when you look at sort of, some people say, oh, we'll go for sort of a smaller firm, but actually some of the bigger firms, they have great packages, fixed fee deferrals, Goodwin do that sort of stuff here. We work with a lot of founders companies, a lot of law firms do, and you get real value add in terms of the advice and give you the connection they can make. So think about your advice, and again, take the time with them. Go and grab a coffee with your lawyer. I meet people with coffees all the time. I take time, we chat, because there's going to be a chemistry there as well. Think about it in the long term. You want to find a lawyer that is going to work with you from the beginning and can scale with you throughout that process, and they actually get to know your business understanding. That's a really valuable resource when you're sort of going through the various different stages of your company growth cycle. So I will.
Yeah, no, that's helpful, Ali, and I think you've actually answered one of the questions that came in, which is, what's your opinion about the best way for founders to organize themselves in order to defend against rapacious VCs or funding partners in general? It's a great question, and I think what Ali was talking about there in terms of number one, understanding why you are picking the investor that you're picking. What do they bring to your business? Do they bring commercial introductions, for example, that will help you grow revenue and get to cash flow break even? Is it smart money versus just money? And then secondly, these deals tend to get structured, no matter what kind of financing you're talking about, a venture financing, an angel financing, there is a market of terms around each of those financings. And if you're talking to the right group of advisors, those advisors do those deals, and they know what market is, and they know, and they can tell you where to push a little bit, and they can tell you where to back down and simply, you know, accept market or go in a different direction rather than seeking that outside funding. So I think so much of this comes down to expertise and market, you know, knowing markets, working with people who know those markets, and ultimately thinking about the value that those investors bring. So excellent question. Thanks for passing that along. And I will take the next, our number 8 in the 8 great actions that successful entrepreneurs take. And we've covered this concept a little bit. It's be thoughtful about valuation, but keep the lights on. So there is always this tension between founders and investors in terms of the amount of money that you want to raise and the amount of the company that the investors want to buy. And there's a tension. And for earlier stage tech entrepreneurs, we tend to find a real focus on this issue. And as we work with serial entrepreneurs who have done this time and time again, it becomes much less critical to them. I think some of our more seasoned founders will say, you know, if it's within a certain range, I'll take the valuation because my focus is on growing the pie and making this a win for all parties. And if my slice of the pie is slightly smaller, but the size of the pie is much bigger because of this investor that I brought in who introduced me into the market or introduced me into supply chains or whatever other value that investor might bring, I think most of our seasoned founders would say that is an excellent trade-off, and I'll do that. We have one bullet that says halitosis is better than no breath, and I've heard many entrepreneurs say that, and it really is true. You know, get the money in, even if it's dilutive. It's important to keep those lights on and continue to fight another day. And that is the formal part of our 8 great. Although Jeff, I think you might have maybe a bonus. I don't know.
Is that the critical 9th move? You know, by the way, I do think we may want to rebrand this thing because the title is super long. So but it was better than the other candidates, which we had, like the 8 great moves, like Jagger, you know, that entrepreneurs make. So we're still in branding, figuring that out. But yeah, the bonus round is our Founders Workbench, which, whether you're a Goodwin client or a Goodwin prospect or somebody else in the ecosystem, you know, we invested our time and our effort to, you know, put this into the world. We did it, you know, during the financial crisis, 2008. We were the first law firm to do it. And really, from our perspective, what we wanted to do is create an online resource that would be as helpful as possible to entrepreneurs and others in the ecosystem. And truly, we didn't even require even an email for access. And the whole point was to open source the process of starting a business. We actually have a document generator and a dilution calculator and a whole bunch of other helpful things that we just thought people should have, whether they're working with us or not. And in that way, we truly see the value of the community and to invest in that community. And we continued to iterate and to improve upon it. And so we just wanted everybody to be aware of it, have fun with it, and we love your feedback, good, bad, or indifferent on it, because ultimately it's that feedback loop that helps us address the needs of the next version of this.
And let me take just one. Thank you, Jeff. That's helpful, and it was certainly. It's got some terrific substance in there for everybody to just peruse, completely free, no obligations. Let me just tie together a couple of things that we talked about earlier. We have a couple of minutes left. Let me just take 30 seconds. Jeff and I were both talking about the timing of forming the entity and then contributing, assigning all of the IP into that entity. And one very important point around timing there is you want to make sure that you have issued your founder equity before that IP is assigned into the company. And it's a very simple tax concept. You're going to pay nominal value for your founder's equity because you're basically paying $1 in total for your shares in a company that is a shell entity. It has no value. And the IRS will look at that dollar you pay and say, yeah, that's fair value because there's nothing in the company. If you assign the IP into the company before you take your equity out, now you're paying $1 for equity in a company that has value because all of this IP has been contributed into the company, and that's a bad fact. So the one key takeaway around timing around this is form the entity, issue your founder equity, and then assign the IP in that order.
Good sequencing point. One other thing just to build on the network, because I feel like the prop tech ecosystem is such an incredible story of growth and size. And I think that having represented, as we all have on the video here, represented a number of businesses and entrepreneurs, I do think that the level of strategic interest in companies in the prop tech space comes in a lot earlier than I would say, a typical tech company where we see it come in around the B round or whatnot. And I do think as all these entrepreneurs know, that distribution of your products and services within this ecosystem really can make the difference between winning and losing in prop tech. And so, but I also understand that there are some big behemoths out there, and so dealing with them might be a little bit anxiety ridden. I think that the great move is to figure out, in terms of value, how that strategic partner can really move the needle, because you will be asked with respect to money investments, not just to make that investment, but also there'll probably be a strategic partnership deal of some type along with it. And to just be careful thinking it through in terms of the equity that you're giving and the value that you're expecting, and really try to embrace those partners and just be realistic about it, and try to have a good data-driven conversation in terms of working with them, as well as VCs who are in the space, who are kind of the general VCs who have some folks who are super interested in prop tech, as compared to specialty funds that are just prop tech funds. And so I think it is an age of enlightenment in terms of prop tech. We're certainly thrilled to be part of it and active collaborators in it. And we do thank you, for the opportunity to give you this presentation today.
Ali, any final words?
No, I would agree with all of that. It's very similar in the UK. Definitely get all your IP, incorporate your company first, then bring all the value in. Absolutely. And we're seeing lots of prop tech companies popping up in the UK, and Jeff's right. There's lots of sort of real corporate interest there, and it's sort of balancing that alongside VC and just thinking about the issues that brings in with sort of the corporate side. But super interesting space, and really great opportunity. Great to be a part of this. So thank you.
Terrific. So on behalf of all of us, thank you everybody for tuning in. Enjoy the rest of the conference. We will for sure. And we'll be around if anybody wants to reach out and do any of the little networking events. We're around, so would love to catch up.
Thanks.
Thank you.
Thanks, everybody.